Hey guys, I'm Ryan Keeton with eXp Realty, and this is another in our series of informational interviews that we're doing to try to get some additional information. And this one today is specifically on conventional loans, how they differ, what they are, what they aren't, and got lucky enough to get a great lender here with me. And I will let you go ahead and kind of take the floor, introduce yourself, and tell us how long you've been doing this, who you work for, and go ahead and cover how to get a hold of you. And of course, we'll recap on that as well at the end.
Awesome. Absolutely. Thank you, Ryan. My name is KJ Hoffman. I'm one of the executive mortgage bankers for Quicken Loans. I've been with Quicken for just about 3 years now. You can contact me through a few different ways, through email, phone number. I also have a online review page where a lot of clients can actually take a look from past clients and realtors I've worked with where they've been able to leave reviews. All that information will be provided, and I'm sure Ryan will be able to get that out to you for more specifics.
Okay, great. So like I said, what we're going to cover today is a conventional loan. So how would you define a conventional loan?
Sure. So good question. Typically, how I like to break it down is there's two main types of loans that people will usually go for the most part. You're going to be looking at like an FHA loan, which is going to be a government-backed loan, and then you're going to have a conventional loan, which is not going to be backed by the government, but it's actually going to be backed by private institutions, private lenders, things like that. So the conventional loan is probably going to be the most common loan out of all the ones that you can get aside from FHA. It is a little bit more, not difficult, but just a few more pieces that you need to have to be able to get qualified on a conventional. But there's a lot of benefits of having a conventional loan. So pros and cons to both of those. And then, we'll go about talking about what those look like as we go through here.
Okay. So speaking of the benefits, you said there's a couple additional benefits. So what do you think are a couple of the best benefits on having a conventional loan versus, say, an FHA or a USDA loan, which maybe some people tend to gravitate towards?
Sure. So what I would say is I'll actually take a benefit, which sometimes people will think is a negative. A lot of people think on a conventional that you have to have a large sum of money down, like you have to have 20% or more down. And that's actually one of the biggest myths. Conventional loans are really awesome because you can put a minimal down and still be able to get, quote unquote, one of the best loans. You can put a minimum of typically about 3 to 5% down. Some of those are going to depend on if you're a first-time home buyer. Some of those are going to depend on the program that might be specifically available for you in your area. But you do have the availability of putting a smaller amount down, which a lot of times is a misconception. Another great benefit is the mortgage insurance. So it's probably something everybody's heard of. It's kind of the elephant in the room, but there's going to be two different kinds of mortgage insurance for the most part. You're going to have your FHA mortgage insurance, which is referred to as MIP, and then you're going to have your conventional mortgage insurance, which is referred to PMI. Now, the really nice thing about a conventional loan is on a government-backed loan such as FHA, the mortgage insurance rates are set by the government. There's a certain formula that is used, so every lender has the same kind of mortgage insurance. Now, on a conventional loan, it's a little bit different. How that's going to work is the PMI is actually calculated by each lender specifically. And that's going to be a really nice benefit because if you're with the right lender and you have the right qualifications for a conventional loan, your mortgage insurance can be quite a bit lower, which is obviously going to equate to a much lower monthly payment, which is everybody's goal at the end of the day usually. I've never had anybody call into us and say they want a higher monthly payment. So really nice on that end when it comes to a conventional loan is being able to have lower mortgage insurance.
Okay. Yeah, I think we might circle back to mortgage insurance here in a minute, but one of the things that kind of popped in my head, and I know that is probably another misconception out there, is around the credit scores needed for a conventional loan. A lot of times people will think, okay, well, I can go FHA because they're a little bit more flexible. They're allowing me to have a lower credit score, so maybe more people can get in the property. how true would you say that is? And I know that's a little bit of a loaded question with the fact that we're dealing with the COVID virus at this point, but in general terms, what are the credit score requirements for a conventional loan versus maybe a government-backed loan?
Absolutely. Great question. So let me start by breaking it down in this way. So the FHA is what is considered flat-based pricing. And then you have a conventional loan, which is going to be considered risk-based pricing. So just to kind of tie back the two, how the FHA is going to look upon it is their minimum credit they're going to require is typically a 620. Now, there are some programs that will allow you to go lower than that, but let's just stick with that without muddying the water. So their minimum is a 620. If you have at least a 620 or higher on the FHA, they look upon you the exact same as if you had an 800 credit score. You're not actually going to get affected. So it's flat-based pricing. Okay, so that's one really good benefit with the FHA is if your credit is a little bit lower, you can still kind of be looked upon by other lenders as having good credit in a sense. Now, on a conventional loan, it will be risk-based pricing. So it's going to be based off of tier systems. The higher the tier, usually the better kind of loan you're going to be able to get in regards to potential cost, potential interest rate, things like that. Now, the conventional also does say a minimum score to get qualified is a 620. Usually, the only reason somebody would go with a conventional loan if their score is a little bit lower in that 620, 640, 660 range is if they're offsetting that with a larger down payment. That sometimes can help compensate. Okay.
Now, it circles back to the PMI, right?
Exactly. Circles back to the PMI. So not to muddy the waters anymore, I'm going to get to your point, I promise. But basically, if let's say, for example, somebody has a 640 credit score, we would consider that fair to below fair credit. Okay. Mm-hmm. That is typically going to be a credit score reserved for an FHA loan, just because you're usually going to get better terms and you're not going to get hit as hard for the credit. Now, let's say that 640 credit score is putting down 20%. If you put down 20% through a conventional loan, you do not have that monthly mortgage insurance, where on the FHA, you would still have that. So that's why somebody would go that route. But to get to your original question of where it typically starts to make sense to go conventional, I always say that a minimum credit score of a 680 or higher is usually where we want to potentially start exploring if that conventional is going to make sense. And then it's going to go in tier systems from there. So if you're at a 680 to a 700, that's basically tier one. If you're at a 700 to 720, that's tier two. 720 to 740 is tier three. And then anything above a 740, you're going to get the same pricing. So I have a lot of clients that will be like, well, my credit's at 800. I should get the best pricing ever. That is absolutely true. They will. But once you're at a 740 or higher, in lender's eyes, it typically doesn't really matter a whole lot.
So to kind of add that additional layer on that tier system, can you touch briefly on DTI, which essentially means debt to income limits or debt to income ratio, and exactly how that kind of plays in and basically just define it?
Absolutely. So you kind of hit the nail on the head. It's debt versus income ratio. So the way that you can, well, let me take one step back. So what a lot of people will actually think, and a common misconception is they'll think that their total debt is what's going to hurt them. So like, let's say they have a car loan, some student loans, and then a credit card. And all of that is about $50,000 worth of debt. A lot of people think that that's actually what's being taken into account, when in reality, it's actually your monthly payments for each item. So if you have higher monthly payments, that's what's typically going to get you into a little bit more hot water. Where if you have just a high debt, but it's a smaller monthly payment you owe every month, that's actually a good thing for you when it comes to qualifying. So debt versus income is going to say, let's take that example. Let's say you have a car loan for $200 a month. Let's say you have a student loan for $50, and let's say you have a credit card for $50. So your total debt right now on a monthly basis that you're obligated to pay is $300 a month. Now, let's also say that the new housing payment, just for easy math, is going to be $1,000 a month. And that includes everything of your taxes, your insurance, and everything. We're going to take that $1,000 a month plus the $1,300 a month. And that means your total obligation with the estimated house payment is $1,300. and then you divide that by whatever your gross monthly income is. So not your net, but your actual gross monthly income. So let's say, for example, somebody makes $60,000 for the year. They're on a salary basis. That would break down to $5,000 a month. So what we would take is the 1,300 divided by 5,000, and that would give us a percentage. So let me pull out my handy dandy calculator here. We'll go 1,300. We'll divide it by 5,000. That means they're at a 26% debt versus income. Okay. So you can go all the way up to 50% on a conventional loan when it comes to debt versus income. So this person, for example, would be great. Yep. Now, here's another misconception that I'll kind of throw out there to finish off the question is a lot of people will think that debt to income plays into what kind of mortgage they're going to get. Sometimes they're like, hey, my debt to income is only 20%. I should get the best interest rate, the best cost, everything. Mm-hmm. It doesn't quite work like that. It's actually more based on a pass fail. So you're either below 50% or you're above 50%. Regardless of where you're at, as long as you pass, it's going to be the same. Or if you fail, obviously we have a little bit of work to do.
Okay, cool. So with FHA and USDA, which we're going to cover in another video, but those homes, the home also has to qualify, not just necessarily the person. So whenever it comes to a conventional loan, are there any types of homes that wouldn't qualify for a conventional loan? And I know that's a little bit of a loaded question because it's also dependent upon the lender, but in general terms, is there anything that wouldn't qualify?
Sure. So I'll talk about generalities and then also just talk about Quicken Loans as well. So from our side of it, we can help with anything in regards to single family homes, townhouses, condos, anything along those lines. When it comes to mobile homes, manufactured homes, it's not something we're able to assist with. So I would say that's the main thing through us. Most lenders are going to be the same way. Where mobile and manufactured can be a little bit more difficult to get qualified for through any kind of lender. In regards to the house, though, like let's say, for example, it's a short sale or it's a foreclosure. A lot of people think that they're not able to attack those, but you actually can. The biggest thing is the house needs to be in livable condition. Can't be run down, can't be dilapidated. If the house, let's say, for example, has, some old shag carpeting you want to take out and some wallpaper you want to take down, it's just cosmetic stuff, and it's just maybe an ugly house, absolutely. But if it's something where the foundation is cracked or the roof, needs repair with leaks and things like that, that's where it's going to be some things that actually have to be repaired before closing. So I always tell people that we finance ugly, but we don't finance broken. So if it's just cosmetics, absolutely. But hopefully that kind of helps answer the question.
Yeah. So I want to kind of go back to the mortgage insurance real quick, because it just made me kind of think of something that does mortgage insurance drop off at any point, or does that stay on there for the life of the loan?
Great question. So if we're talking strictly in regards to conventional loans, it will absolutely fall off at some point.
20%, right?
Exactly. You got it. So once you have 20% equity built into the house, either naturally by the house just growing in value or by you paying the house down, then it will fall off. Or what you can do as well is, let's say that you have, you put 10% down on the house to start out with, and it's been 2 years, you've done some renovations to the house and you feel, okay, I now have 20% equity built in, but you don't want to wait for it to naturally fall off. You can usually refinance, or you can have a new property inspection done, or appraisal, if you will, and send it to your lender, and the lender will be able to remove that mortgage insurance for you.
Cool. So, and you may have already covered this, but is there anything that you can think of that you wish people knew about conventional loans, or that is a major misconception that you would like to clarify or clear up?
The one thing that I would say that I had written down, was looking at some of my notes too, is the 20% down to qualify. That's definitely a misconception. You do not need to have the 20% down. That's great. I have a lot of clients that are pleasantly surprised where they're like, wow, I can put 3% down and still get a conventional loan. I thought I was going to have to go FHA.
Yeah, until I started selling real estate, I thought it was 20% and that's it. There was no variable. And then, just learning the fact that you can 3%, 5%. A lot of that has to come into that DTI and, the things that we've talked about that go into that tier system. But having that ability is pretty huge. And like I said, I think that's a very common misconception out there.
Absolutely. Absolutely. And the other thing too, touch on that is you don't have to be a first time home buyer. If it's your second home that you're buying, your third home, your fourth, fifth, whatever it is, you can put 5% down as a minimum, which is great. So a lot of people will like to keep their cash on hand as long as, their monthly mortgage insurance is not outrageous, which on conventional, usually it's not. And you can keep a little bit more cash on hand as long as you're comfortable with that monthly payment. One thing that I would say, more of just a misconception in loans in general, maybe, is when it comes to interest rates. That's a question that, us lenders get all the time. And sometimes it's like, okay, where do we go with this? And everybody wants to know their interest rate, right? And it's perfectly normal. And there's nothing wrong with that whatsoever. Everybody's got to do their due diligence because us as humans, we want to make sure we're getting a good deal, right?
Absolutely.
So when it comes to interest rates, a lot of people believe or have maybe been told or think or one way or another that their interest rate is locked in at the pre-approval stage. This is a big misconception because definitely something that you want to know as a first-time home buyer. I've even had people that have bought 4 or 5 homes that after I get them pre-approved, they're like, okay, what is my locked-in interest rate? And we kind of got to have that conversation of, hey, it doesn't work quite that way, which is perfectly fine. But how interest rates work, it's kind of like the stock market or it's kind of like gas prices. They change every single day. They either go up a little bit, go down a little bit, or they stay right about the same. Now, when it comes to the changes of interest rates, you can lock in an interest rate when you have an accepted offer on a home because there's typically going to be lock periods. Usually most lenders are going to have a 45-day or a 60-day lock period. That's most common. Okay. So the reason why you can't lock it in is, let's say you get pre-approved and let's say we locked in an interest rate, for example, that rate is only good for 45 days. And that's not 45 days for you to find a house. That's 45 days for you to have an accepted offer and then completely close on the house, which normally closings will take for Quicken 30 days or less. Sometimes it's going to vary with your lender. But that's, kind of the reason why it can't be locked. So, that's one thing definitely to keep in mind is just know that your process to make things a little bit easier is go get approved, figure out what you're approved for, get an idea from your lender of, hey, where are rates at right now? I'm not looking for something hard because they can't give you something hard, but where's kind of a range of where I might be falling? And then go find that right house. Once you find that right house, then at that point we can be, okay, what's the specifics? Give me the black and white. And then you can have everything nice and pretty and tuned up.
Excellent. That's great advice. Great information. So, if someone is getting ready to start the pre-qualification process and reaching out to some lenders, I guess I really have 2 questions. Because one of the things that this kind of actually just sparked a question right now is that one of the things that people will say to me all the time whenever I talk to them about getting pre-approved is, oh, I don't want them to keep dinging my credit. If I go and I shop around and I talk to 3 or 4, which is a good thing to do because, not all lenders are created equal, just like not all realtors. I mean, different people do different things and they're going to have different interests. So, what would you say to somebody that's like, I don't want to, call a couple different places and make sure I get the right system or the right person for me because I don't want to hurt my credit?
Yeah, I hear that on a daily basis. So that's a great question. The one thing that I will give people, and I give a lot of people this inside tip that no one really knows for the most part, is you are protected to shop by credit bureaus. So credit bureaus allow you, when it comes to getting a mortgage, 14 days from your first credit pull. So let's say
you might want to preface that that's not whenever you're going to go get an automobile, you're not protected the way you are with a mortgage.
Correct. Exactly. So it's just strictly mortgage lenders. So let's say, for example, you go to lender A today and you go get a pre-approval, you get your credit pulled, whatever the case may be, right? And then tomorrow you call lender B and you're like, crap, I don't want another ding on my credit. You have 14 days from that first credit pull where your credit will not be affected and it won't be dinged more than once. Now, we're pretty conservative at Quicken because we would much rather, tell you something and it be in that ballpark than tell you something that it not be even close. Um,
Exactly the same way.
so good. That's really our motto with a lot of things is we like to overestimate rather than underestimate and come back to you and say, hey, you owe us all this extra money, because that's never a fun experience by any means. But in regards to the credit, is some lenders are going to tell you, and some things that you look up on Google are going to say that you have a 30 or a 45-day window to have that credit pulled. So usually there is a little wiggle room, but again, we like to say 14 days just so you're as safe as possible. So I would say if you are looking to shop, what I tell people, because you got to do your due diligence. If you find
Sure.
that right lender right off the bat, then go do your thing,
Because
and
it's
be
all
with
about,
them.
to
But
me, it's just like choosing a realtor. I think it's all about comfortability. Who do you feel like really has your best interest? And I think as humans and as people in general, we have good gut reactions that tell us if we're in the right spot to be, that is going to be taking care of us and looking out for our best interest. So I agree with you 100%. I think it's really smart to do your due diligence, talk to some different people, and then you're like, wow, man, I really liked KJ over there. Man, he was, I like what he had to say.
exactly.
Because a lot of times you'll find that, okay, yeah, I may be able to go to lender B and they give me a tenth of percent better rate, but then it's a nightmare throughout the whole process where they went to with you and you're able to, okay, maybe for whatever reason you were a tenth of percent higher, but it was the smoothest transaction. There was never any worries. You felt good the whole way because it's already stressful enough. You're making the biggest purchase you'll ever make in your life. So uh, I'm with you 100%. I'm glad that you said that because I do think it's important. And I think if someone is not encouraging you to go shop around, there's probably a reason for that.
Exactly. If you have a lender that is, like you said, not encouraging you to do your due diligence, and they're quoting you, the lowest interest rate possible, and they're telling you, oh, we can lock this in, and they're just promising you the stars and everything under the sun, there might be a red flag there. Not always, but there's probably a red flag. So that's where I would say, like you said, do a little bit of due diligence, make sure you're comfortable with that person, because at the end of the day, it comes down to comfort. And also, what a lot of people don't think about is, you're right. Okay, price is very important, 100%.
Mhm.
But is that person going to be able to close for you? How is that company and how is that person going to treat you after you close on the loan? Because you got to think, this is a 30-year commitment you're getting into. The first 30 days is very important, but the next 30 years after that, how's that company going to treat you when it comes down to it? So doing your due diligence is very important.
Yeah, because whenever you purchase a home, there's going to be enough curveballs, whether it be an inspection or whether it be whatever, something pops up on title unexpected. There's going to be enough things that kind of flow through that without having to worry in your back of your mind, is that $3,000 they quoted me on closing costs going to turn into $5,000. That's a lot bigger of a headache to try to overcome than the other stuff. So I think that being as smooth as possible. So um, one of the final questions I want to ask is, whenever someone is deciding which loan is best for them, is there any specific advice that you would give them for making that determination? I think we've kind of covered this a little bit, but just kind of wrap that in a bow. Besides the fact of taking the advice, I think with this, if someone watches this, they're going to get some good advice now. They're going to be a lot more informed whenever they talk with the lender. But is there anything else that you would say, if maybe they were talking to somebody else, is a good thing to kind of have in their head to be thinking about whether when they're deciding if they want to do conventional or something else?
Yeah, I mean, to be honest, I mean, it's finding that right person and feeling comfortable that they're putting you in the best position possible. I think finding somebody that is also going to break down both options in depth, rather than just saying, "Hey, here's kind of a brief overview of this and a brief overview of this. Which one do you like?" Go through the pros and cons as much as humanly possible, and really understanding what's going to make the most sense for you. When it comes to an FHA loan, for example, I would say if your credit score is below a 680 and you're looking to put more of a minimum percentage down, which is perfectly fine and perfectly
Mhm.
normal, FHA is probably going to be a better route for you. it's going to make more sense, and there's nothing wrong with that. It's a great first-time home buyer program and loan itself. When it comes to a conventional loan, if your credit score is going to be, at that 680 to 700 mark and higher, and even if you're looking to put a little bit smaller percentage down, you're still probably going to be okay. But if it's really a balancing act, how much are you comfortable and thinking about putting as a down payment, and what is your credit score at? I think those are the two determining factors of what's going to make the best loan for yourself.
Okay. So, and finally, I always try to get this information out of lenders, and I always have a pretty thorough discussion with my clients. But I'd like to hear your perspective on what do you feel like are the most important things that a client can do? Okay, now they've decided, all right, I'm going to go with you, KJ. I'm going to do the loan. How and what can they do to make sure that process is as smooth as possible from the time that you get till I get them accepted on a house till the time that we close? What are the things that they should do right off the bat and continue to do to make your life easier and ultimately theirs?
Absolutely. So our system's a little bit different than most lenders out there. So I'm going to speak strictly on behalf of Quicken Loans. Our process is set up as kind of failure proof. And what I mean by that is we have an online technology. Most people out there have probably heard about it. It's called Rocket Mortgage. So that's one misconception is you have Rocket Mortgage and you have Quicken Loans. Quicken Loans is the company. Rocket Mortgage is strictly just our technology. So that's where you can apply for a loan. You can call into us, and then we set you up on Rocket Mortgage. But ultimately, you're going to have what's called a Rocket Mortgage account. That's your online platform, online database. It's kind of our bread and butter, if you will. So when clients go on, they will have a complete direction of this is what I need to do next. These are the documents I need to upload. And here's what, my next updates are going to be for the home itself. So it makes it really simple and easy, strictly because you get push notifications, emails, texts, whatever the case may be from the app that's going to say, hey, there's a new to-do list item for you to do from when we get into process all the way to closing. And then also we're going to give you updates via email, phone call, text. It's going to say, hey, here's where the loan's at. Here's our next step. So really the thing that they have to do is make sure that they're checking their online application. That's about it. It's pretty simple.
Yeah, and I think that kind of goes to where I was talking about, because one of the conversations that I have with my people is that, whenever we get to the point of we get this under contract, everybody's accepted, we get a fully executed contract, that really there's only a couple of things that's going to hold this up from closing on time. One, we have absolutely no control over, which is the appraiser. The other one is you. That if you are asked for information and it takes you a week or 2 weeks or whatever to get something to your lender, well, guess what? Now you've just pushed that process along to where we may not get to where we want to be on time. So, well, thank you very much. Go ahead.
No, well, I was just going to say being engaged is very important. You're absolutely right. So I make it sound very simple, but if you're not engaged in the process of how we have it set up and you're not checking in on your Rocket Mortgage account on a daily or every other day basis, then yes, you're going to get behind and you could potentially delay your closing. So it's just as important to put the responsibility on us as it is on yourself. So that's what I would say is it's a team game. You have to do just as much as we are doing to get to the finish line. But that would be the main thing I would say for sure.
Well, great. Well, I definitely want to thank you very much for taking the time to do this. I would encourage anybody that's watched this to share it with anybody that that is looking to possibly purchase a home, because the information we were able to cover here was fantastic. Watch it again, because this is a lot of the same type of things that I would talk about whenever I was with you as well. So, thank you very much again. If you want or don't mind, please again, just go ahead and remind everybody who you are, who you're with, how to get in contact with you. And that way we can share this out and hopefully get some additional information out there to everybody.
Absolutely. Yeah. So again, my name is KJ Hoffman. I'm an executive mortgage banker here with Quicken Loans. The best way you can contact me, and again, we'll have this information elsewhere, but my direct line here at Quicken Loans is 480-305-9612. I also am available weekends and nights. So if you need to contact me then, best way to contact me is my cell phone, which is 602-410-3517. I really appreciate the time today, Ryan. It's been awesome. Hopefully people get a little bit extra knowledge out there. And if they need more, feel free to reach out for anything else.
All right. Thank you all very much.
Thank you.